You know, when you think about where the big money is moving in the economy, you probably picture like stock tickers flashing red and green.
Right, or some secretive Silicon Valley boardroom.
Exactly. But the truth is, the real wealth, like the quiet generational wealth, is hidden right in plain sight. It's the concrete you drive over.
It really is.
Yeah, it's the building where you grab your morning coffee. So today, we're taking you on a deep dive, cracking open an exclusive real-time brokerage list from Texas to show you exactly how that wealth is quietly trading hands, while you're just sitting in the drive-thru.
It's an entire ecosystem that most people just drive past without a second thought. I mean, every single piece of that commercial landscape tells a financial story, provided you know how to read the signals.
Right, and we've got our hands on the perfect decoder ring. It's an April 17th, 2026 curated newsletter from Eureka Business Group.
Or EBG for short.
Yeah, EBG. They're a commercial real estate brokerage established in 2008, based out of McKinney, Texas. And they put together this listings of the week email. So our mission today is to decode this document for you.
Which is going to be incredibly fun.
Oh, absolutely. We're going to reverse engineer these specific properties, starting from like the under $2 million range all the way up to massive institutional level plays. Basically uncovering the hidden strategies investors use to generate serious wealth.
Think of this list like looking at a menu of risk and reward. The strategies completely shift depending on whether you're buying, a tiny drive-through or a massive government complex.
Okay, let's start with the appetizers then. Easing our way into this world with the under 2 million category. Looking at the list, these properties seem to offer the most peace of mind for an investor.
The safest bets, essentially.
Right. So we have this listing in Decatur, Texas. Looking at the imagery, it's a 7-brew drive-through coffee shop, but the footprint is tiny. It's barely bigger than a 2-car garage, just over 500 square feet.
Barely any building there at all.
Yeah. It's brand new, 2025 construction, and it's positioned in a corridor entered by a Walmart and a Lowe's, which the household income there is over $100,000, by the way.
Which is a brilliant model when you think about the sheer volume of premium iced lattes required to justify a nearly $2 million price tag.
Seriously, that's a lot of coffee.
It is.
Yeah.
But the value isn't in the square footage. That compact footprint means the overhead for the tenant is microscopic. I mean, it's practically just a commercial kitchen and a window.
Right.
And because the construction is brand new, there's no deferred maintenance, no aging roof to patch, no ancient HVAC system about to fail. They are targeting high-income commuters who want convenience and have the disposable income to support it.
And looking at the rest of the list, this is clearly a deliberate strategy. We also have a KFC in Ardmore, Oklahoma, sitting right off Interstate 35.
Massive traffic there.
Yeah, totally dense retail surrounding it. And a new 20-year lease with a 400-plus unit operator. Then, down in Pflugerville, Texas, there's a Freddy's Frozen Custard that's been operating since 2009 with like 25,900 vehicles per day driving by.
The traffic counts are key.
Definitely. And bumping up just slightly into the 2 to 5 million tier, there's a Slim Chickens in Aubrey, Texas. Brand new 15-year lease sitting on a major highway frontage where over 38,000 cars pass by every single day.
Notice the thread connecting all of those, though. None of these are mom-and-pop shops testing out a brand new concept. You are looking at established, national, or large regional brands locked into high-traffic corridors.
The newsletter keeps using the term absolute NNN ground lease for these properties, and it heavily highlights zero landlord responsibility.
That's the magic phrase right there.
Right. So for anyone who isn't a commercial broker, my understanding is that NNN stands for triple net, as in the tenant pays the net taxes, the net insurance, and the net maintenance. If the roof leaks, the tenant fixes it, not you.
Exactly. That is the beauty of the structure.
Yeah.
The landlord is completely insulated from all those operational headaches.
So it's essentially the real estate equivalent of a dividend-paying stock on autopilot. You just buy the building, the tenant handles literally every physical problem, and you just check your bank account on the first of the month.
That is the dream scenario.
But okay, here is where I get skeptical. If I have zero landlord responsibilities and a guaranteed 20-year lease from a massive experienced operator like that KFC in Ardmore, why doesn't every single person with capital just buy these? What's the trade-off for all this safety?
Well, the catch is the price of admission. In commercial real estate, risk and reward sit on opposite sides of a seesaw. The trade-off for all that sleep at night safety is that you pay a massive premium up front.
Oh, I see.
Yeah, when you buy that KFC or that 7 Brew, you aren't really buying the brick and mortar structure. The building is almost irrelevant. You are buying the creditworthiness of that tenant and the guaranteed traffic flow outside their window.
So I'm paying for the 38,000 cars driving past that Slim Chickens every day.
Exactly. And because the risk of a massive national chicken franchise defaulting is incredibly low, your return on investment, what the industry calls the cap rate, is going to be much lower compared to riskier deals.
Got it. So lower risk, lower return.
Right. The cap rate is just a quick way to measure your annual return. Like if you buy a property for $2 million in cash and it generates $100,000 a year in rent, that's a 5% cap rate. Investors flock to these absolute NNN leases for capital preservation. It's reliable, headache-free cash flow.
So it's the ultimate defensive play. You aren't going to double your money in a year, but you aren't going to lose it either.
Spot on.
Okay, so if triple net leases are the ultimate defensive play, what happens when an investor wants to go on the offensive? They must have to start looking for broken things they can fix. Which brings us to a totally different narrative in this newsletter. It's the fixer-upper mentality.
Right, but fixing up in this context doesn't necessarily mean swinging a hammer or pouring new concrete.
Correct.
Often, it means fixing the financials, finding anomalies.
Interesting. Well, let's look at this exclusive EBG listing in McKinney, Texas. It's a medical and office space, a bit larger, approaching 3,000 square feet. The photos show it's currently being used as a gym.
Okay, under $2 million.
Yeah, under $2 million. It consists of 2 combined units, meaning a buyer has the flexibility to lease part of it out or use the whole thing. But the real eye catchers are these 2 bullet points. First, it's selling below the county assessed value. And second, the seller is offering owner financing.
Ah, owner financing.
Is that just a way to bypass traditional lending entirely?
It is a massive cheat code in the right environment. Think about the friction of traditional banking right now. High interest rates, tight lending standards, endless paperwork.
It's a nightmare.
Exactly. So if a seller is willing to act as the bank, you can negotiate the terms, the down payment, and the interest rate directly with them.
That's huge.
It is. Couple that with a property selling below its assessed value, which is a genuine financial anomaly, and it suggests you have a highly motivated seller. A savvy investor can leverage those 2 factors to acquire the asset with far less friction and immediate built-in equity.
That is creative finance in action. But there's another one here that caught my eye in the 2 to 5 million tier. It's a massive industrial and flex space in Roanoke, Texas. About 16,800 square feet.
That's a good size.
Yeah, both units have fully built-out air-conditioned offices. The brochure highlights that it's outside city limits and features outside fence storage currently used by the owner, which they note can be leased out.
Okay, sounds solid so far.
But there is one bullet point I have to challenge here. The brochure explicitly lists short-term leases as a reason why this property is attractive. Wait, short-term leases sound terrifying? I thought we just established that 20-year leases are the gold standard.
Normally, yes.
Unless. Is this just a backdoor way to kick the current tenants out and immediately hike the rent?
You hit the nail on the head. If you are looking for an autopilot investment, short-term leases are your worst nightmare. But if you have that offensive fixer-upper mentality, short-term leases are the golden ticket.
Wow, okay.
This is the classic value-add play. Because if a tenant is locked in for 10 years at a cheap rate, you're stuck.
You can't raise the rent to match inflation.
You are paralyzed. You own an asset underperforming the current market for a decade. But with short-term leases, the new owner can step in, wait a few months for those contracts to expire, and immediately renegotiate the rents up to current market rates.
Oh, and because the value of a commercial building is directly tied to the revenue it generates.
Raising the rent instantly increases the overall value of the property.
So you're buying the property for what it is today, but paying yourself for what it could be tomorrow.
Precisely. And don't overlook the operational details in that Roanoke listing either. Being outside city limits is huge for industrial tenants.
Because of taxes.
Taxes, yes, but also it typically translates to fewer zoning restrictions and less bureaucratic red tape. Combine that with a fenced outside storage area, which is a massive advantage for heavy equipment or logistics companies, and you are buying a highly functional asset with an immediate clear path to force its revenue higher.
Okay, so we've gone from isolated autopilot coffee shops to quirky value-add industrial spaces. Let's zoom out a bit and look at the macro trends in the $5 to $10 million range.
This is where things get really strategic.
Yeah, at these higher price points, it seems like investors aren't just looking at the physical building anymore. They are like surfing demographic waves and capitalizing on retail synergy.
Absolutely. Once you move up the price ladder, you are no longer just buying an address. You are buying into the economic gravity of an entire community.
We have a 10,000 square foot retail center in Richmond, Texas. It's completely leased up, newer 2017 construction. But the selling point isn't the building itself. It's the fact that it is located next to a top-performing HEB in a high-income Houston suburban growth corridor.
HEB has a massive pull in Texas.
Right. And then, up in Mount Pleasant, Texas, there is an even bigger retail center, nearly 65,000 square feet. 100% leased, offered at a 7.30% cap rate with a low rent basis. It's an ALDI anchored center, but crucially, the brochure notes it has a Walmart shadow anchor.
Ah, the shadow anchor.
You know what that makes me think of? It sounds incredibly mysterious, like those little remora fish that swim right next to great white sharks. You don't own the shark, you don't control the shark, but by just being in its orbit, you get to eat all the scraps it leaves behind.
The remora fish is a fantastic visual. I love that. But take it a step further. Unlike the fish, in this scenario, you actually own the ocean the shark is swimming in.
Oh, that's a good point.
Walmart spends tens of millions of dollars on location analytics. They know exactly where the regional shoppers live, what their incomes are, and how far they are willing to drive. Walmart's sheer gravity pulls in thousands of customers from miles around.
And they've done all the homework for you.
Exactly. As the owner of the adjacent ALDI-anchored center, you benefit immensely from that spillover traffic without spending a dime on your own demographic research or managing the Walmart itself.
So you're basically drafting off the billion-dollar marketing and location research of the biggest companies in the world. Your smaller inline tenants, the nail salons, the sandwich shops in your strip, they thrive entirely because they are catching the runoff from the giant next door.
That's it. And that concept explains the strategy behind the Richmond property as well. That retail center isn't just a structure. It's a bet on the high-income demographics of that Houston growth corridor, anchored by the immense local loyalty to HEB.
Right. Retailers know that if they set up shop next to a dominant grocer, their survival rate skyrockets.
It's guaranteed foot traffic.
Which perfectly sets up the most unique listing on this entire newsletter. It's a nearly 38-acre residential land play in Cedar Hole, Texas. It's a Cedar Hill Independent School District asset sale being sold via sealed bid.
Completely raw land.
Yeah, residentially zoned dirt. So why is a massive plot of empty land mixed in with all these high-performing retail centers?
Because you are looking at the very beginning of the entire cycle. Retail follows rooftops.
Rooftops, meaning houses.
Exactly. By acquiring 38 acres of residentially zoned land, an investor or developer is preparing to build the very neighborhoods that will eventually drive the traffic to the coffee shops, the grocery stores, and those shadow-anchored retail hubs.
Wow. So you're basically buying the raw ingredients of a future demographic wave. You are buying the customer base before the stores are even built.
It requires immense vision and, honestly, a lot of patience. But the payoff is establishing the foundation that the rest of the commercial ecosystem will eventually depend on.
That is incredibly fascinating. But here is where it gets really crazy. Let's look at the whales, the $10 million plus category.
The big leagues.
Yeah. This is where the price tag requires serious institutional money. And looking at this list, the entire investment strategy seems to mutate when you add another zero to the price.
The players change, the scale changes, and the definition of a reliable tenant reaches a level that most people can't even fathom.
We have two massive properties here. First, a 97,500 square foot industrial facility in Fort Worth, Texas. It features an absolute NNN lease on an irreplaceable 8.9-acre infill site, meaning it's built in a highly developed area where you couldn't find another empty lot if you tried.
Infill sites are extremely valuable.
But the key detail is the tenant. It is a mission-critical defense industry facility with a 28-year WALT and annual rent bumps.
Okay, and the second one?
The second one is in Plano, Texas. Almost 37,000 square feet leased to the U.S. federal government. It's a purpose-built federal courthouse with 17 years remaining on the term. And EBG specifically notes this is selling at a significant discount to its estimated $50 million plus replacement cost.
Now, before we dive into the math on these, I think it's vital to note for you listening that at this tier of investment, personal politics regarding the government or the defense sector.
Right, whether you lean left or right.
Exactly. All of that is left completely at the door. We're not endorsing any of it. Institutional investors are evaluating one thing only: the financial certainty of the tenant. And purely from a creditworthiness standpoint, the federal government is the gold standard.
Okay, totally understood. So I want to ask about this acronym, WALT. A 28-year WALT with annual rent bumps takes us all the way to the year 2054. How do investors even begin to calculate the value of a property 3 decades into the future?
So WALT stands for Weighted Average Lease Term. It is a metric used to measure the average time remaining on the leases within a property. When you see a 28-year WALT with a defense contractor or a 17-year term with the federal courthouse, you are no longer just buying real estate.
What are you buying then?
Well, the physical walls matter, but what you are really acquiring is essentially a government-backed bond that happens to be wrapped in a physical building.
So the signature on the lease is the actual asset.
In many ways, yes. But the physical nature of these specific buildings acts as the ultimate insurance policy. Notice the specific phrasing used in the newsletter: mission critical and purpose-built.
Right?
A federal courthouse or a defense manufacturing plant isn't just an empty warehouse. It has highly specialized infrastructure. Think about the reinforced concrete, the specialized security routing, the custom IT networks. The tenant literally cannot afford the logistical nightmare or the astronomical cost of moving.
Which guarantees they stay and pay the rent year after year.
Exactly. And that brings us to the final brilliant piece of the puzzle: discount to replacement cost. The Plano Courthouse has an estimated replacement cost of over $50 million.
Which means
That means if the General Services Administration had to buy land and build that exact high-security facility from scratch today, it would cost them $50 million. If an institutional investor can buy that existing building for, say, $30 or $40 million, they are heavily insulated against market downturns. It creates an incredible safety net. You have the ultimate credit tenant in a highly specialized building they can't leave, purchased for less than it's worth to rebuild. It is the absolute pinnacle of risk mitigation.
that is mind-blowing. So what does this all mean for you listening right now? We've just walked through a masterclass in risk management, hiding inside a real-time real estate newsletter.
Hiding in plain sight.
Exactly. We've seen that whether you're looking at a tiny 510 square foot coffee shop footprint indicator or, a value-add industrial space with short-term leases in Roanoke or a multi-million-dollar federal courthouse in Plano, there is a distinct calculated logic to the madness.
There's always a strategy.
Always. The principles of absolute NN leases, the brilliant strategy of drafting off shadow anchors, and the long-term security of WALT are the invisible forces dictating the flow of millions of dollars across the state of Texas and beyond.
It really proves that commercial real estate is not a monolith. It is a highly specialized, nuanced ecosystem where investors can dial in exactly what kind of risk they want to take on and precisely how they expect to be compensated for it.
So if you want to dive deeper into this world, our source material notes that Joseph Goslin, the managing principal of Eureka Business Group, curates these lists and actually has a LinkedIn newsletter dedicated to retail real estate news.
Highly recommend checking that out.
Yeah, they even host their own commercial real estate deep dive podcast where they break down the market further.
It's an industry that massively rewards curiosity and a sharp eye for detail, which brings up an interesting point to leave you with.
Oh, lay it on us.
Tomorrow, when you're waiting in line at a drive-thru or driving past a strip mall that's perfectly situated right next to a massive grocery store, take a moment to look at the ground beneath it. Ask yourself, who really owns that concrete? What are the lease terms keeping those doors open? And are they quietly surfing the demographic waves of your neighborhood, building generational wealth while someone else entirely fixes the roof?
A perfect thought to end on. Thanks for joining us on this deep dive.